This is Macro Horizons, episode 314, Overemployed, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of March 10th. As investors focus on the half-point increase in the underemployment rate, we're left to ponder why the BLS doesn't publish an overemployment rate. One thing is clear, Doge would have a use for it. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market saw a notable tone shift as it relates to the trade war and the response in the equity markets. The equity markets came under pressure, and the Treasury market benefited from a flight to quality rally. 10-year yields got as low as 4.10, and the process of consolidating with 10-year yields in a range of 4.10 to 4.30 continued. It is notable that the market has grown increasingly concerned that the fallout from the trade war will impact real GDP and the direction of employment in the U.S. The pace of growth is currently tracking in negative territory, as evidenced by the Atlanta Fed's GDP Now tracker. However, one of the key drivers has been net exports, as importers in the U.S. attempted to get ahead of the tariffs by bringing goods onshore early. This has clearly increased the trade deficit. However, over the course of the next several months or quarters, one should expect that will be unwound. So to suggest that the Fed might be readying a monetary policy response to a slower growth profile seems a bit premature. The U.S. rates market also saw the February employment report. Headline payrolls came in at 151. That was compared with the 160 consensus and the 125,000 in January. Private payrolls effectively matched expectations as well, printing at 140,000 versus the 145,000 consensus. That being said, within some of the details of the report, we saw the unemployment rate unexpectedly increase 0.1% to 4.1%. This occurred as the labor force participation rate declined 0.2% to 62.6. This means that the increase in the unemployment rate would have been presumably higher had the labor force participation rate not slipped. So the details added a somewhat bond bullish skew to the report. We'll also note that the unemployment rate on an unrounded basis came in at 4.139 compared to the 4.011 previously. Said differently, it wasn't that far away from rounding up to a 4.2. The underemployment rate increased 0.5% to 8%, and that marks the highest since October 2021. Overall, it wasn't surprising to see the Treasury market modestly extend the prevailing bid as a function of the BLS data. Another development of note is that the trend toward a steeper yield curve managed to move even further, with 2s 10s making it above 35 basis points in a move that will suggest is long overdue. We continue to see the path of least resistance being toward a steeper yield curve as the 2-year sector drifts lower in rates, with the reality of potential Fed cuts later this year coming back into focus.
Well, we now have February's jobs report, and sure, it was softer on the margin, but not so soft as to really change anything from the Fed's perspective. But what the NFP numbers did do is cement the new lower yield range in treasuries. We now have 2s trading comfortably below 4%, 10s far closer to 4% than 4.50, and despite earlier this year what was concerns that maybe the Fed would abandon their cutting bias altogether, the realities of the latest update on the jobs market show enough risks facing the outlook that the Fed will almost certainly keep its cutting bias intact. Additionally, while the job cuts on the federal government level started to show up in this month's data, we now have a marginally softer departure point for next month's read, where there are still plenty of risks tilting toward the downside in terms of the trajectory of hiring.
It is a very interesting dynamic with the backdrop of what's going on in Washington, D.C., potentially spilling over to not only federal contractors, but also state and local governments, as well as the private sector more broadly. We're certainly sympathetic to the perception that the risks are now skewed lower for the labor market, as opposed to the previous sentiment that the exceptionalism of the U.S. economy would continue indefinitely. In practical terms, this translates into investors being on guard for any evidence that the labor market has deteriorated further. In February, we did see a higher than expected initial jobless claims print. However, that was largely reversed, and, as you point out, Ben, the headline payrolls growth was solid. I'm more concerned about the increase in the underemployment rate. At 8%, this is the highest the underemployment rate has been since October 2021. And the issue is that full-time workers are losing their jobs and replacing them with part-time work. Such a rotation has traditionally been associated with a further increase in the unemployment rate. Not only the underemployment rate, but also the unemployment rate as workers are stopped out of the full-time employment market. We also had more benign average hourly earnings figures and a downward revision to January, all of which suggests that from the perspective of monetary policymakers, the employment aspect of the dual mandate might increasingly come into focus as the Fed readies to announce no change in the policy rate on the 19th of March.
And let's not forget the latest development on the tariff front, with new levies going into place this week, only to then be walked back in terms of a list of exemptions that effectively encapsulates everything that was tariffed to begin with. And so, for all intents and purposes, after the original 1-month delay to tariffs, we now had tariffs and a list of exemptions that once again has kicked the proverbial can down the road of when it is we may actually see higher import taxes between the US, Canada, and Mexico. Aside from the actual economic fallout and higher prices, which obviously has been well discussed at this point, our takeaway is that the announcement and exemption and potential delay has all added to the broader level of uncertainty around the Trump administration's economic policy, and in keeping with the idea of the risks facing the labor market, all of that uncertainty does not bode well for a resurgence in hiring anytime soon. After all, if one is running a business dependent on importing anything from Canada or Mexico, some of the U.S.'s largest trading partners, the fact that there's an unknown of whether the goods you're importing are going to be more expensive or not is not a case to invest heavily either in new infrastructure. It's certainly not a point of advocacy for increasing your labor force, and rather what tariff unknowns do is reinforce the wait-and-see dynamic. That applies to the Fed, but it also applies to U.S. firms as well, which is hardly a positive growth impulse, and a big reason why we see 10-year yields trading back far closer to 4% than they've been in quite some time.
One thing that wasn't wait and see that the tariffs did accomplish is that they brought net exports deeply into negative territory, which has dimmed the economic outlook for the first quarter. Now, of course, by bringing forward imports to avoid tariffs, one should assume that there will be less imported over the course of the next several months or quarters, which will reverse the negative impact of net exports on real GDP. However, when we think about this in the context of the potential response in the equity market and risk assets more broadly, and how that could flow through to tighter financial conditions that the Fed might ultimately feel compelled to respond to say that this has introduced a major uncertainty would be an understatement. It's well within the set of potential outcomes that the equity market sells off further, financial conditions tighten, and the Fed changes the narrative around normalization. From the Fed's perspective, in the event of a significant sell-off in the equity market, simply to keep financial conditions where they were in January, for example, rate cuts would be warranted. The flip side is that monetary policy makers might appreciate a little bit of a de-wealthing effect, as higher equity valuations have been credited for driving a portion, at least, of the stickier aspects of the inflation complex that we've already seen.
And along with the moves in yields and latest developments on the data front, we'll also argue that there's been an important flip in terms of the positional bias that we've seen in treasuries after the bulk of the start of the year saw the market underweight treasuries or short duration, whether that was either in outright terms or in steepening fashion. But the fact that we've seen yields move to and subsequently through the bottom of the range, along with the replacement of inflationary angst resulting from tariffs to more pronounced growth concerns resulting from tariffs, has also come with what we'll argue has been a shift in terms of the outlook for the path of yields. Specifically, the market has gone from underweight to now closer to neutral or maybe even leaning slightly long, which has in turn driven an inflection in the pain trade, which was at one point an extension of the move toward lower yields. But now from the current departure point, there is a case to be made that perhaps the pain trade is a sell-off back toward higher yields. What remains to be seen is how that translates to the shape of the curve after we've seen 2s 10s bounce a bit off its recent flat prints, but by no means would one characterize the curve as steep in the traditional sense, given the fact that the Fed is still in the midst of a cutting cycle.
And we have seen the 2-year yield finally drift well below effective Fed funds of 4.33. We came into this part of the cycle assuming that effective Fed funds would function as a ceiling for nominal 2-year yields, and while it was breached on a couple brief occasions, by and large, this strategy has held. As we look at 2-year yields now comfortably below 4%, the question is, have they richened too much, and do we need to see a modest reversal in the 2-year sector before staging a more significant rally as Fed rate cuts approach on the horizon? We're less convinced that the market is rich at this moment than we were that it was cheap when 2-year yields were at 4.30. Now, as we look forward over the course of the next couple weeks, we will be focused on the FOMC decision, which no change is expected in the policy rate, and perhaps more importantly, how the Fed adjusts its SEP and dot plot. Recall that there has recently been a strong tendency for the Fed to simply mark the dot plot to market. So whether directly or indirectly, policymakers are reflecting the sentiment of the futures market. As it currently stands, the market is pricing in more than 75 basis points worth of rate cuts this year. So if the Fed follows the prior pattern, perhaps we see what had been a 50 basis point cut messaging from the dot plot translate into a 75 basis point messaging, and that would benefit the 2-year sector and, to your point, Ben, create a meaningful curve steepening impulse.
And this gets at one of our core tenets and the more constructive outlook we have on treasuries as an asset class over the balance of the year, particularly in the front end, as you touch on, Ian. And that is the fact that despite all of the developments in the global economy since the pandemic and even over the last 12 months, particularly as treasury supply concerns have abated under the new Trump administration, which is that treasuries will continue to benefit from their safe haven status, and there's an implied premium, the opposite of term premium, that exists in U.S. rates, in that something could always go wrong enough in the economy on the geopolitical front that would quickly result in a move toward dramatically lower yields. A move toward dramatically higher yields, well, that would require more consistent evidence of a strengthening labor market, of reaccelerating inflation driven by the demand side, and a more material tone shift from the Fed. None of that will happen overnight, and that's why on a structural level we continue to favor a dip buying bias as opposed to a rally selling one. Even if there is some scope on a tactical basis for rates to retrace from current levels, it's difficult to envision us getting back to 480 10s anytime soon.
And I think that is also very consistent with the fact that when the Fed is in a wait-and-see mode, that the Treasury market tends to hold a range, particularly in durations. So it follows intuitively the 10s and 30s should trade in a range that, as you point out, Ben, has probably already been defined. So as we drift around, let's call it 420 to 425, the next big move will likely be a function of Wednesday's CPI figures and how that translates into the market's understanding of the Fed's reaction function to realized inflation.
Why is it reaction function and not proaction function?
I don't think that proaction is a word.
That hasn't stopped us before.
How proactive of you. In the week ahead, the Treasury market will have a variety of fundamental influences from which to derive some type of trading direction, although we do think consolidation will be the path of least resistance, especially for the longer end of the curve, with the 10-year sector in particular in the process of defining the new trading range. On the fundamental side, the most relevant data point will be core CPI, which is released on Wednesday morning and is expected to show that during February, core prices increased 0.3%. Headline inflation is seen up 0.3% as well, and core PPI is expected to come in at 0.3. In addition, Tuesday sees the JOLTS data. Now, it's for the month of January. However, given the Fed's focus on JOLTS, the market has recently been content to trade the information as a close second to payrolls, frankly. The week is capped by the University of Michigan survey. This is the first look that the market will have at March's confidence figures. And recall that the medium-term inflation expectations have been running particularly high, with a somewhat perplexing divergence between reporting Democrats and reporting Republicans, with the former seeing much higher inflation and the latter foreseeing a far more benign inflation environment going forward. On the supply front, we have Tuesday's 58 billion three-year notes, Wednesday's 39 billion 10s, capped by Thursday's 22 billion long bonds. As a general theme, we expect that there will be plenty of demand for Treasury supply, although an auction concession follows intuitively given the magnitude of the recent rally and the fact that the process of cheapening up the market for 10s and 30s will surely conform with the traditional trading dynamic, if nothing else. And on a final note on the data front, on Thursday, we also see the initial jobless claims figures for the first full week of March. Given the emphasis on the evolution of the employment landscape, combined with the mixed messages from the BLS's employment report, we wouldn't be surprised to see jobless claims once again become a key tradable event, as it represents, if nothing else, the closest thing that investors have to a real-time gauge of the jobs market. With this backdrop, we like consolidation in the longer end of the curve, with perhaps a modest sell-off to accommodate the incoming supply. But as far as the two-year sector, which is understandably closely linked to the evolving monetary policy expectations, we're biased for a further rally, which keeps a steeper 2s, 10s curve decidedly on the table. Same logic applies further out the curve with 5s bonds. We do see room for that to extend steeper, with any curve flattening of note being an opportunity to simply reset or add to a core steepening bias. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as we ready for the clocks to spring forward on early Sunday morning, we're reminded that 1 cup of coffee equals 2 hours of sleep. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.